Research shows that most of the variation in returns among equity portfolios can be explained by the portfolio's relative exposure to three compensated risk factors: market, size, and price risk. Structuring a portfolio around compensated risk factors can change priorities in the investment process. The focus shifts from returns chasing through stock picking or market timing to diversification across multiple asset classes in a portfolio. The model in this slide illustrates this multi-factor approach. Investors receive an average expected return above T-bills according to the relative risks they assume in their portfolios. The main factors driving expected returns are sensitivity to the market, sensitivity to small cap stocks, which is a size factor, and sensitivity to value stocks, which is measured by book-to-market ratio. Any additional average expected return in the portfolio may be attributed to unpriced risk. The size and book-to-market effects appear in both U.S. and international markets. Strong evidence that the risk factors are systematic across the globe. This graph demonstrates the higher expected returns offered by small cap stocks and value stocks in the U.S., non-U.S. developed, and emerging markets. Note that the international and emerging markets data is for a shorter time frame. Small cap stocks are considered riskier than large cap stocks, and value stocks, as defined by a higher book-to-market ratio, are deemed riskier than growth stocks. These higher returns reflect compensation for bearing higher risk. A multi-factor approach incorporates both size and value measures and exposure to non-U.S. markets in an effort to increase expected returns as well as reduce portfolio volatility. An effective way to capture these effects is through portfolio structure. The historical return premiums for compensated risk factors are documented in the graph here. Equities have offered a higher expected return than fixed income, but these stronger premiums come with higher risk. Structuring a portfolio around compensated risk factors can change many aspects of the investment process. Rather than focusing on individual stock or bond selection, investors work to achieve diversified, controlled exposure to the risk factors that drive expected returns. An investor first determines his portfolio's stock-bond mix and then decides how much additional small cap and value to hold in pursuit of higher expected returns. The level of risk assumed in the fixed income component may depend on why an investor is holding fixed income. For example, an equity-driven investor who wants to reduce portfolio volatility may hold less risky debt instruments, while an investor pursuing higher yield or income may take more maturity and default risk. This slide documents the frequency with which the value and size premiums have been positive over the various time periods throughout the history of the U.S. stock market, from 1926 through 2011. As the results illustrate, U.S. value stocks have outperformed U.S. growth stocks, and U.S. small cap stocks have outperformed U.S. large cap stocks in a majority of all the rolling return periods measured. If we examine the top bar here, you can see that for every 25-year period, U.S. value beats U.S. growth 100% of the time, and U.S. small cap beats U.S. large cap 97% of the time. This is a significant statistic that should reinforce our position that investing properly requires a diversified approach with a long-term focus.